Well, good afternoon, good morning, good evening to all of our participants who have joined us today. My name's Zara Ritchie. I'm the Global Head of Transfer Pricing for BDO. I'd like to welcome you to this webinar hosted by TP Minds Digital Series and BDO sponsoring. If I could introduce the panel today, on your screen, hopefully you see four of us. So we have Michael Smith, who's a transfer pricing partner in our Melbourne practice. Aletta, who is the National Head of Advisory for BDO, and Sharon Arasu, who is the Tax and Treasury Head for carsales.com. So thank you for joining us. The intention, if I just, that's a picture of all of us. The intention today is for us to have a fairly informal discussion dealing with obviously year-end transfer pricing issues and some of the accounting considerations, including IFRIC 23. So you will find that you are in listen-only mode. We are going to have a series of discussion amongst the panel, and we are also going to answer any questions that you have. Now, we can leave time at the end of today's panel to answer your questions, but it would be much better from our point of view if you'd like to log your questions as we go, particularly as we're talking about particular topics of interest. If you find that you want to ask a question, please do so, and we'll try and address it at the time and in context. You will also receive some communications after the webinar, including feedback and some short key message documents, slides and the recording. Please do complete the feedback. It's always beneficial to us and obviously to the organisers, TP Minds, to ensure that we are hitting the mark in terms of what's of interest to you, and possibly also get some ideas for some other events that might be worthwhile hosting in the future. Now, this is a series that is being run by TP Minds. So this is the first of four. There are weekly webinars on a Wednesday at the same time. So please do register for the other topics if they're of interest. The second topic is short-term and long-term issues for consideration. The third topic is dealing with legal agreements, and the final topic will be addressing financing funding with the ATO joining that discussion as well. So I'd like to say thank you to Sharon particularly for joining and sharing some corporate perspective, because I know that's what the audience and participants are particularly interested in hearing. So we'll try and keep it practical. We'll try and focus on some real life experiences, and Mike and Aletta will obviously share some perspectives in terms of what discussions we're having with our clients as well. So I've just outlined the session, and as I say, we're going to deal with the challenges and insights and share those with you. I think it's fair to say that situation so far, pretty much everybody has been impacted by COVID-19, and unfortunately most people in a negative way. There are a very small number of businesses and individuals that have done very well during COVID-19, but unfortunately probably 80% or more of the market have been impacted in a negative way. So in Australia, I think we've been quite fortunate. We're moving towards what is more of a perhaps whatever our new normal becomes. And I know there are some other countries out there as well that have got, similar positive direction, but none of us know what the future holds. None of us know whether we're going to drop back into a wave 2. None of us know economically how we're going to recover. There are many industries that have probably done reasonably well until now, and they might be hit, a delayed hit, good pipelines, but those pipelines are now past, and what's to come. So we're all at different stages and phases of this experience, and I guess none of us have all of the answers, but we'll try and address as many transfer pricing practical considerations as we can throughout this webinar. So I'm just going to do a very quick scene setting, and then we'll open it up to the panel to have some discussions. So impact on the global business environment, and I guess just to put this into context, the four of us are all based in Australia, in Melbourne, but our audience is a global audience. So we have many countries participating from around the world. So we are going to try and keep a global slant on this, but also, of course, link it to Australia, as that's the part of the focus as well, the Australian footprint. But everybody seems to have had some sort of disruption to their supply chain. whether that's because you've been sourcing product from a particular country or series of countries that have had to go into lockdown, supply shortages, input materials, logistics challenges, no flights, all sorts of challenges which have disrupted so many supply chains of all different sorts. Lots of businesses have refocused on changing supply chains, changing sourcing, changing locations of manufacturing, for example. So I think some of the positives that will come out of COVID-19 will be the opportunity for businesses and countries to refocus on, okay, what do we do well in country and how can we do it better? And does that create economic opportunities for the country as well as for the business? So we will cover some of that on our next webinar as well. Travel restrictions, of course, reductions in demand and consumer spending unless you're buying online, but buying online brings its own challenges, and anybody that is buying anything online will realise that it takes, weeks, sometimes months for deliveries to take place. There's been a lot more credit card fraud, all sorts of frauds and other disruptions as well. Cash flow we'll talk about in quite a little bit more detail, because cash flow obviously has been the number one issue for most businesses to manage. Declining asset values maybe bring some opportunities as well. What is the long-term impact? As I said before, I don't think we really know what that might be. Some companies will come out of this faster than others, and some companies will find that they have, a longer economic cycle, if you like, to recovery. We look at this in terms of 3 phases. The first phase is really survive. The second phase is really, what's your sort of resilience piece in terms of trying to ensure that you can survive and thrive as best you can during COVID-19. And then the third phase, hopefully we all get to that as quickly as possible, is how do we come out the other end, and how do we actually thrive again as businesses rather than just sort of survive or, maintain a sort of a constant flow of riding the wave. And we'll touch on probably all 3 of those phases throughout the course of this discussion. So I have got on the next slide there what has been the global response. So I think it's probably the same experience in many countries, that tax authorities fortunately have been quite empathetic and understanding in terms of the pressures that businesses are under, and not just tax authorities but governments obviously more generally. But in dealing with transfer pricing, of course, our focus is more around tax authorities. I think there's been a general willingness to compromise and to slow down in terms of compliance activity. Certainly when I talk to my global colleagues around our network, that's a similar message that we're getting. There's a lot of government stimulus measures that have been introduced, as in Australia, for example. I think many of you will be very familiar with our JobKeeper measures and the like, and many countries out there have got similar types of measures, but they're called different things. That introduces obviously economic opportunities to keep businesses afloat, but it also raises some interesting transfer pricing considerations, which we'll touch on today's webinar as well. There are some countries that haven't introduced any stimulus measures and haven't slowed down their integrity measures at all either. And my observation is that in Asia particularly, there's probably less willingness to take a different approach or to take a softer approach than what there has been in sort of Americas and Europe more generally. So some variations between countries, which of course you as finance, tax directors, CEOs, COOs all need to be very mindful of. So whilst we've seen a suspension of some of this activity, we will touch on this, but let's not get complacent about that suspension or that deferral, because governments are being supportive, but they have to fund the stimulus measures, they have to fund the economic crisis, just as we all do in the businesses that we are operating in. And so it's only a timing issue. And what we're seeing, we expect the tax authorities to come back sort of thick and fast in the next 6 to 12 months. And of course, their focus is going to be on transfer pricing, on, well, how have losses in the supply chain been allocated across the globe? Is that fair and equitable? Is your limited risk distributor really limited risk, low risk versus no risk? How have you treated those? How have you actually shared the pain? And is that appropriate? And we'll touch on some of those questions today, and we'll touch on a few more in the next webinar as well. I'd like to perhaps just revert now to our panel discussion. And I'd like to kick off by asking a question to each of the panel members. Perhaps it's you know, what is the most important issue that you're facing at the moment, but how has COVID-19 impacted you as well? So maybe Sharon, if I can kick off with you, what's been the most sort of significant impact and how are you managing COVID-19 as a corporate?
Okay, well, happy to kick this off. I guess for me specifically, because I head up tax and treasury, COVID-19 has had an impact all around. So any sort of economic stop is bound to have its challenges, especially when you're in a global role or in a global company. So for me, I've had two sorts of challenges unfolding at the same time. One is, of course, the tax world. So keeping up with all of the stimulus packages, not just for us as a business, but for our customers as well, you know, digesting what we can have or can access state by state and then country by country, and understanding what that means for us, what we can do, what we can't do. So there's the tax bit. And then, of course, there's also the treasury bit. So, you know, when you're in an economic stop or a challenging economic time, cash is king. So in anything that you do, is having to think about how can I actually make my cash go further, or how can I hang on to my cash during these uncertain times. So being able to balance the tax and the treasury at this time has been interesting. It has certainly been challenging. And I guess there's another layer to that, is just insurance and risk. So COVID-19 is, I hate to use this word, but it is, I'm going to use it. It's unprecedented. We haven't seen this before. It's nothing like the global financial crisis of 10 years ago. So it is something that's completely different. And I think the way it's impacted me the most is just in the amount of learning that's had to happen in such a short period of time.
Thanks, Sharon. Mike, what are your thoughts?
Yes, so I think the word unprecedented, we throw it around a fair bit, but it's probably the right word to be using at the moment. In terms of what I've seen with my clients, initially when it kicked off, there were lots of conversations around cash flow management and making sure that they had the cash to be able to weather the storm. There was a big focus as well on government stimulus measures. So obviously JobKeeper in Australia and other similar measures around the world, I'm sure were really top of mind. But now that the dust has started to settle, I'm having a lot of clients ask me about, as they go into the year-end process, the cash tax impact of how their financial results are falling out. And I think it's fair to say there's lots of unforeseen issues there. So you might have a limited risk distributor that might be making profits, head office that's not, which might be meaning that you pay tax in a jurisdiction and not in another, which is not necessarily the most efficient thing to be doing. But also we're seeing, for example, limited risk distributors in losses at the moment, just by virtue of what's going on in their local markets. So all those things raise some really interesting questions as we go into year end.
Thanks, Mike. We'll come back to some of those points in a bit more detail. Aletta, you bring a different perspective on this webinar, and we thank you for joining us, because your focus is obviously on accounting and accounting issues, but there's an extremely important overlap, of course, between how companies manage transfer pricing and what some of the challenges are going to be from an accounting perspective. Do you want to just reflect on what you're experiencing so far?
Yes. Zara, it is wonderful to be here with all the tax people. So thank you for having me as an accounting person. From an accounting perspective, corporates have been through a tough few years with a lot of new accounting standards. So 30 June 2020, which is our reporting date for most entities in Australia, was supposed to be an easier year. And the focus would have been only one new standard, a new standard on leasing, which is a bit of a nightmare, but you know, the expectation is we just focus on one standard, the new leasing standard, and one new interpretation, which is IFRIC 23, around uncertain tax positions, which we've often talked about, and that interplay between transfer pricing and IFRIC 23. So we had our eye on new leases, IFRIC 23, and then COVID-19 happened. And suddenly, you know, people went into survival mode, as you've all explained, around cash. And I think the first instance was, forget about lease accounting, forget about IFRIC 23, let's just survive and look at cash. And there was a lot of talk about that. But now clients are coming back and saying, okay, 30 June is fast approaching. We now have to account for all these things. So all these government stimulus and JobKeeper, what are the accounting principles? We still have to do lease accounting. That's not gone away. But it's actually gotten a bit worse because now there's a lot of negotiations between lessors and lessees around rent concessions. You won't believe it, the standard setter has made an amendment to this new leasing standard to deal with COVID-19 related rent concessions. It was super fast standard setting because there were issues around that. You know, so how do we deal with that? Also, there's a lot of pressure on entities around impairment testing of their assets. And remember, we've just brought a brand new asset on the balance sheet, right of use asset as a result of leases, and that have to be tested for impairment. You know, so two key focus areas have turned into numerous focus areas. And in a way, I feel a little bit sorry for IFRIC 23 because in the past, it's been overshadowed by new accounting standards, IFRS 9 and 15 and all the drama around that. And now it's overshadowed by COVID-19.
It'll have its day in the sunshine, I'm sure, Aletta. So I guess as we are close to year end, I mean, that's the focus of this discussion. So we're sitting here on the 10th of June, and for some Australian entities, as you say, Aletta, 30 June is their year end. A lot of companies have later dates. So for example, you know, September or December. So perhaps they have a little bit more of an advantage in riding the wave a little bit longer rather than, you know, being in an extreme position. And we're probably still a little bit in the eye of the storm for many companies. And perhaps we can't look at this, I think, from a TP perspective in any case as a 1 year issue. This is an issue that's going to progress for, you know, probably 3 to 5 years, depending on your business and depending on the industry. And let's hope the tax authorities take a pragmatic approach to that as well. So Sharon, if I come back to you, from a corporate perspective, what are some of the issues that you're thinking about as you get to year end?
Well, the first thing I'm thinking about is how this will be the first time we're doing year end completely remotely. I'm trying to get my head around that. It's going to be interesting, certainly. But I think from a tax and transfer pricing perspective, there's obviously the usual year end stuff that we think about. So where have we undertaken our activities? Have we done the pricing correctly? Are there any adjustments that need to be done? But also now when we have COVID-19 as well, the other thing that I'll be thinking about is, are any one-off adjustments necessary? So are all my transactions, do I have to charge for all my transactions? Are there additional transactions that I've done or services I've provided in the last 3 or 4 months that I need to charge for, or that I'm going to be expected to charge for? Have I provided funding in countries or to subsidiaries that I haven't previously, where I might need an intercompany agreement? Those are things that I'm thinking about. And I think overarching all of this is there's the technical position the transfer pricing rules require us to look at, but then there's also the practical one. And as an example, if I think of intercompany funding, if I'm having to provide short to medium term funding to a subsidiary that I've never had to fund before, the question then becomes, well, if this is a once-off and it's only going to happen for 3 or 6 or 9 or 12 months, from a transfer pricing perspective in Australia, do I run the risk of maybe not fully complying with the ATO's debt financing PCG, or do I fully comply? What are the things that I need to do, and what's the cost-benefit analysis? I think that's going to become more important this year in particular, when we're trying to ensure, as you said, the survival and resilience of our subsidiaries, and then having to overlay on that compliance with the transfer pricing rules. The other 2 things I think that will be different this year is whether you need additional documentation to provide extra support for positions taken, because there may be some positions taken this year that we would never have considered taking before, or they were never necessary before, or 2, they may be unusual for our business. So it might be usual in the context that a lot of businesses are having to do it, but it might be unusual for our business. So thinking about whether I need additional documentation. And then the third thing to think about is whether that documentation needs to happen now. So we talk about contemporaneous documentation, but in reality, a lot of times you might have invoices and things that provide for form and substance to match, but you might not have the actual papers underneath written up. And I think this year that'll be a little bit different, and we'll need to have that written up to ensure that we're thinking about all the things we need to be thinking about in terms of our transfer pricing positions and our transfer pricing adjustments. From a non-TP perspective, the one thing that is different this year is understanding how the stimulus package measures that have been introduced, and the ones in particular that we've taken advantage of, are going to be recorded in our accounts, and then how that flows through, whether it flows through a tax return or a tax note or some form of additional disclosure, particularly for reporting companies. It'll be interesting and important to understand how that is reflected and what story that's going to be telling.
Thank you, Sharon. We'll come back to that because I'd like to, in a moment, ask Aletta about some of the accounting measures and the stimulus measures. Just picking up on one of the points that you raised, which we'll come back to a little bit as well, but you know, it really is very much a two-step, or at least a two-step process, isn't it? Because companies can't do everything that they need to do between now and year end, and we don't have all of the information available to us. So it's a little bit like government policy on the run. You know, you have to make decisions based on the best available information that you have at the time. And then when you look back, you know, competitors or opposition or whoever it might be, tax authorities might look back and say, well, perhaps that wasn't the best decision that you made, because, you know, hindsight's a wonderful thing. But I think you have to make good decisions as best you can in a rush, in an environment that we haven't achieved before. You know, this is nothing like the global financial crisis. It's different. And so, yes, you need to make decisions at year end, and then you need to sort of backfill them in a sense, and either support them or not support them, and move on to what that next decision needs to be. Mike, I'm guessing that some of these are the issues that you've been discussing with clients as well. What are some of the hot issues that are coming out from your discussions?
Yeah, good question. So building on sort of the previous comments from yourself and Sharon, I think it comes down to actually first and foremost understanding what's being reflected in the various numbers that you're seeing as they come in. So I mentioned earlier about looking at the tax paying position, understanding whether you've got deferred tax assets, losses you can use, and making sure you're not paying tax where you need to. But you can kind of do this top-down, in principle approach to try and understand, you know, what should happen and how should it play out. But what I'm seeing is a fair few sort of unintended consequences where what's happened on the ground might not be quite what you would expect. So then you kind of have to get into there and unpack what that is, understand what's driving it, and then work out if you've got levers to pull to kind of correct that situation. So, you know, I mentioned earlier, a limited risk distributor could be in losses. Well, why is it in losses? You know, is it limited risk or is it no risk? And sometimes you'd have a transfer pricing policy put in place that effectively says, well, it's close as anything to no risk, so it should get a limited but low return. But that doesn't necessarily work in the current environment. So I think the main insight I would say is, rather than just look at the top down, what does the theory say? I think you also have to start with your actual set of numbers as they come in. So, you know, 10 months of actuals, 2 months of forecasts. Let's see what they look like. Let's see which ones look on point and which ones just look a bit downright bizarre, and work it out from there. And then, as you say, the accounting issues around some of the stimulus measures, they get reflected in weird and wonderful ways sometimes. So part of that story is really around, well, what I'm actually seeing on my books and records, and untangling that from what's the economics of the thing underneath as well.
So many factors to consider, I think, for sure. And so, Aletta, maybe let's just talk about the accounting issues associated with the stimulus measures, the government stimulus measures. And obviously there are stimulus measures in Australia and all different countries, and all the different participants on this webinar, they'll vary from country to country. So even just getting your head around what all of those different stimulus packages are, accounting issues at a local level, and then I guess accounting issues at a consolidated level, it feels like it's going to get pretty messy.
Yes, Zara, and particularly going to be messy for entities that have 30 June reporting dates, like in Australia, and I know there are other as well. Or even if you've got in the UK with their 31 December, but you listed, you've got interim reporting. And I know in Canada and the US, they've got quarterly reporting. So, but 30 June in Australia definitely is a problem. And I'll start off by saying, from an accounting perspective, often the accounting standards would like you to reflect in the 30 June 2020 financials the fair values at that date, the transactions and events that happened before that date, and then, you know, things that happen after 30 June 2020, we call, you know, after balance sheet transactions, and there are rules around whether you would adjust your financials for those or not. So quite often, you know, as an example, if there's a crash in the stock market or investments in shares, and at 30 June 2020, equity investments are very low, by the time you finalize your financials, which might be 4 months later, although the share prices have recovered, accounting standards say we take a view at 30 June 2020, and that's what you have to reflect. So definitely that's something to remember. So I know you're talking about documentation and getting documentation in early. From an accounting perspective, what I'm definitely seeing and what I would advise entities is you need to lock in and agree your loan renegotiations before 30 June. You have to lock in and agree with your landlord your rent concessions before 30 June 2020. If you agree it, sign the modifications to loans, etc., after 30 June 2020, we won't be able to reflect that in 30 June 2020 financials. And, you know, from an accounting perspective, if you're a lessee and you lock in and agree a modification around a rent concession, there's a resulting gain going in your profit and loss. If you renegotiate a loan that you've got a payment holiday or an interest-free period, it often results in a gain in your P&L. So all of those things will have nice favorable outcomes from an accounting perspective and increase your profit, but only if you've agreed it formally before 30 June 2020. So from our perspective, this is really important. And can I tell you practically, clients are telling us, Aletta, it's next to impossible to have all these lease modifications and loan modifications formally agreed by 30 June 2020. We've got negotiations, we've got verbal commitments. Even in Australia, there's a legislation that says, landlords, please negotiate with your tenants. And we're encouraging you to give them certain relief or waivers. From an accounting perspective, not good enough. We want to know what did you finally agree. So for us, time is really running out. We're really speaking to clients and saying, if you want to get that profit uplift before 30 June 2020, we need to get agreement. The other thing is around government stimulus, Zara. You have to ask a question whether the entity is receiving the government stimulus for its own benefit as the principal or in the capacity as an agent, and you know, maybe as an agent for employees. So is the entity just a flow through? So it's an in and out, and we're just doing an admin function on behalf of the ATO. Therefore, it wouldn't impact our financials. Or is the entity receiving the money equivalent to a grant, which it pays over to employees? Now, in Australia, it's interesting. Entities are required to make these JobKeeper payments to employees and then try and get it back from the ATO if the employees meet eligibility criteria, if the company meet eligibility criteria. So in a way, the entities are taking the risk. If they can't get it back because they don't meet the eligibility criteria, you know, the company is taking the risk, and therefore we would believe normally the company would act as the principal, therefore bring in the government grant and book a salary expense. But definitely from our perspective, time is of the essence, especially rent renegotiations, loan renegotiations, including intercompany, related party, parent subsidiary renegotiations. And the third thing is the government stimulus to understand exactly what the nature of the relationship is, principal or agent.
And that brings in a
Thanks,
whole bunch of different transfer pricing issues, doesn't it? Just listening to Aletta talk through those. So Aletta, one interesting point that you mentioned there was around intercompany rent and loan arrangements. Just to make that really clear, from an accounting perspective, if you're entering into revised arrangements with related parties, those need to be clearly documented before you get to year end to make the accounting treatment clear.
Correct. And it's an interesting one because we've got very particular rules. If you're the lender and you're making changes, what the accounting outcomes are and tests that you have to apply, but also different rules if you're the borrower. What is your assessment? So you don't always get mirror accounting between the lender and the borrower within the same group if you're preparing separate financial statements. Now, I understand from a consolidated perspective, it would be acceptable, but there's a lot of rules around impairment testing, expected credit losses that should be performed on an entity by entity level, and that creates some issues.
And it's going to be really interesting because, you know, we start with the accounting position from a transfer pricing perspective, but then we have our own rules and our own concepts that we have to work around, and of course the OECD guidelines. So just because the accounting treatment says that it should be, you know, A, B, C or 1, 2, 3 doesn't necessarily mean that the transfer pricing outcome and therefore the tax outcome is going to equal the accounting outcome. So if ever there was a year and a time where we need to unpack the accounting and the underlying analysis, you know, it's now. And I think the overlap between having to get things done before year end, having liabilities committed, having agreements in place, etc. There's a lot of commonality in terms of the timing from a tax and accounting perspective. Sharon, if I can turn to you, what from a corporate perspective, what do you see as perhaps some of the key challenges in all of this? And then are there any opportunities? Are there any lights at the end of this tunnel that this brings out as well from a company perspective?
Well, the first key challenge, I think, is just accessing data. So, and I'm not talking about comparable data or transfer pricing data, I'm just saying data. When you have teams working remotely in countries that are in different stages of this COVID-19 pandemic, being able to access data is difficult. So I think that to me is the key challenge here. So if we put that aside, I say the next thing I'm about to say, I say in the nicest possible way. How often does a major economic disruptor like a pandemic come around? I'm not suggesting that we should have one of these all the time, but they do present an opportunity for businesses to take a good look at their transfer pricing arrangements. So to take a good look at how we actually do business. The reality is that whatever was normal pre-COVID is not going to be normal when we come out of this the other side. Things have changed and they will stay changed. We have to adapt. And part of that adapting is changing how we engage with our subsidiaries and our related parties, how we charge, what services are provided, and how those services are priced. That is going to change. So I think a key opportunity here is to look at what we're going to be doing with these and what we're doing with them now. What is temporary, so what's needed to get through to get to the thriving stage, and what is permanent, so what has permanently changed in the structure of how we do what we do. So when you start off from that perspective, I think it's a good time to revisit our legal agreements. So I take on board what both Aletta and Mike have said about needing to have those agreements in place by year end, but it's a good time to revisit them. Are these sorts of pandemic losses currently contemplated in those agreements? And if they aren't, should they be? Is it possible that we can now actually get out of these agreements and craft new ones? Is there a clause in there that states that when something like this happens, that you can actually look at, a different way of doing things? I think also transfer pricing is one of those areas that it is often overlooked. It's either too hard or too expensive, and it's something that comes after all the commercial realities. And I think this is right. I don't think tax drives decisions. I think tax is a factor, but it doesn't necessarily drive decisions. Having said that, where in the past you may not have gotten buy-in or the budget to do something for transfer pricing purposes, that might be getting your benchmarking done, getting your documentation reviewed, or putting in place different structures of transactions, you might find that transfer pricing now can provide a benefit. And whether that's saving some of the losses that you've got because you have an entity that has losses, or exploiting an opportunity from an entity that's suddenly making money because they're now making face masks, and face masks are in fashion. They're making fashionable face masks. That's it, not just normal face masks. And all of a sudden you can command a premium for that, for example. It's thinking about thinking about things like that, and then saying to the people that you work with, or the powers that be, that transfer pricing can now provide you with not just a compliance tick, but a very real, tangible benefit. So I think using this pandemic to maybe negotiate for what you want from a head of tax perspective is an opportunity that should absolutely not be missed.
Yeah, I agree with that.
I think is my point.
Yeah, well, and my philosophy is always don't ask, don't get. So, you know, there's no downside in asking the question and seeing what comes out of it. And I think your point is really important, because if most companies are suffering, you know, losses in this environment, then cash is very scarce, and so companies are trying to save costs. They're trying to, you know, restructure. So in those restructuring operations or opportunities, how can you get a better tax outcome? And, you know, I don't think there's anything wrong with trying to optimize your tax position within the law. And, you know, transfer pricing definitely provides some opportunities for that. You mentioned legal agreements too, Sharon. There is a webinar on the 24th of June. So if anyone's interested in discussing legal agreements in a bit more detail, we're doing one in conjunction with corporates, and also a legal firm that is very specialised in preparing such agreements. So I think that's one to watch. You also, I think, made a comment about transfer pricing not always being a top priority. Of course, to all of us, it's our number one priority, and, you know, we eat and breathe and sleep transfer pricing, but it's not in an environment like this. Of course it's not. You know, there's plenty of other important things that need to be dealt with first. So at some point, transfer pricing will become a priority, or it will go up higher up the important list. But then there's going to be a conflict between time, resource, and cost to get the transfer pricing right versus, you know, a business that might be really impacted by COVID-19. So you've got all of those conflicts in terms of the planning opportunity, perhaps the restructuring opportunity, the level of robust compliance and analysis that's required, and then everything else that just needs to get done. And, you know, TP is still not going to necessarily be the one that's at that top of the list. So it's an interesting dynamic, I think. Mike, can I ask you, in terms of thinking about changes that can be made or that will be made, of course, transfer pricing is never one-sided. It's multi-sided. It's at least bilateral, if not multilateral. You know, what are some of the issues that companies need to be very mindful of? Picking up on Sharon's point about the opportunity to change policies, to make amendments. What are the tricks and traps, perhaps, for companies?
Yeah, absolutely. So probably picking up on the theme of comments that you've all made, there's been a lot of change and it's happened very quickly. So with transfer pricing being a two-sided exercise, or a multi-sided exercise as it is, it's imperative that when you're looking at making these changes or adjustments, that you understand the impact on both sides of that transaction. So to give some sort of practical examples, in the US, for example, they've implemented some rules post-COVID-19 that allow you to utilize current year losses by rolling them back against prior year profits. So that obviously might provide you with a benefit if you have the ability to, you know, take that opportunity. But on the flip side, in the US, they've had a rule around for some time that says if you don't settle your intercompany invoices, if those are payments to be made by a US company to a related party, if you don't settle them, cash settle them by year end, then you can't take a deduction in that year's US tax return. And similarly, they've got other rules around intercompany accounts. If they run for longer than 60 days, or I think it might be 60 or 90 days, they could be treated as capital contributions, for example. So that's, just one jurisdiction that has many different nuances that you've got to be aware of, which really means that when you're going through this horribly fraught exercise of balancing all these things you have to balance at once, you don't just have to do it from a head office perspective. You've really got to go to the next level and understand what it's going to mean in the other jurisdictions in which you're doing business as well. So yeah, that's probably one to watch out for.
Thanks, Mike. And maybe can I ask you to just make a comment in relation to the stimulus measures and transfer pricing, because just picking up the point about, I think you alluded to it a little bit earlier, but picking up the point about who enjoys the benefit, how might that be dealt with in terms of intercompany charges. So there's the accounting position, and there's going to be some specific adjustments from an accounting perspective. But equally, there needs to be some consideration as to how that's applied under whatever is the normal TP policy or what the revised policy needs to look like.
Yeah, so a practical example of that might be around the accounting of wage support programs by governments around the world. So typically, if you were doing a service fee, for example, you'd look at a fully loaded cost base, and you'd probably pick up your salary and your wages and overheads and mark those up. But depending on how the accounting treatment works, the government stimulus can actually sit in a separate set of lines on the P&L. And you might just miss that if you were going to do business as usual. So first step is to understand where on that P&L, when you're calculating those recharges, the stimulus measures might sit. But then after that, you really get to a more existential question around, well, if a government in one jurisdiction is supporting employees or keeping employees in jobs, what does that mean for a recharge? Should you be recharging the costs? Should you be recharging the benefits as well as the costs? And if you're recharging the benefits, does that mean that one country is effectively subsidizing the operations of another? So you kind of get to a bit of this, I guess it was similar to post-GFC. We had the question around tax morality. In this world, maybe it's around stimulus morality. And do you leave the stimulus where it was received rather than think about recharging it to manage a reputational risk that might or might not occur down the track?
Yeah, I agree. I think it's an important point. And I think that some of the policies are going to be very specific about what you can and can't do. Some countries are being very specific, and some countries are being quite vague. And therefore, it's where there's that vagueness that, decisions need to be made, and made for the right reason, but, to your point, might not end up in the location that the government intended it to be. So it's challenging. Couple of questions coming through.
I thought on that point, it would be interesting that the whole notion of intercompany charges and payments and what it actually represents from an accounting perspective is interesting, but I think for your perspective, interesting as well. So from an accounting perspective, we often look at the substance of these payments and not the legal form. So legally, you might call it a management fee, and accounting, we would say, hang on, embedded in that management fee, there's a lease, there's a loan, there could be a lot of things in there, and we strip them out and we account for all those components. What does that do for transfer pricing?
Sharon, do you want to take that one on? Because there's sort of a tax overlay, isn't there, as well as a transfer pricing overlay?
I'm not sure I have an answer to that. I rarely say that. My husband will attest to the fact that I rarely say that, but I'm not sure I have an answer to that, Aletta.
No, while I was listening to Zara, I thought, wow, I'm attending this webinar as a panelist, and I'm just identifying more and more issues. Maybe I should leave.
No, don't do that. Not yet. At least not for another 15 minutes. Look, I think there is some consistency between tax and accounting in that regard in terms of, and transfer pricing in we take a substance over form approach from a TP perspective. Yeah. And so sometimes we do need to unpack, but often that doesn't happen. I'd have to say, I think often is the case where you would have a, you know, a charge that has got a bundle of things included, and they're not appropriately unbundled, and that might have withholding tax consequences, it might have customs duty consequences, you know, there might be a number of flow-on tax consequences. So I think because the lens is going to be on these charges and the allocation of losses more so this year than any other year, I think it's a year where companies need to try and focus on, you know, unpacking those charges very carefully. But I'd come back to the point I made before. I think the conflict is the time and cost and resource available to do that thoroughly and take that robust position. So, you know, it might be down the track before some of these gaps are uncovered.
I think from a practical perspective, you the reality is you will not have time to unpack those charges. And what that means is the only time you're likely to unpack those charges is if you are faced with an audit. And that's something that we practically see all the time, that especially in a customs audit, you know, you get hit with the customs audit and all of a sudden you're sitting there working out exactly what should have been part of the tariff and what shouldn't have been. So that's the reality.
And maybe, Sharon, on that point, I'm just going to flick it around a little bit because there's a question that's come through that I think sort of semi-related to this. And we touched on before short-term actions before year end and then, you know, post year end. Perhaps your comments or your thoughts on how to build your defence file, because as you say, there's only so much you can do before year end and there's only so much time and budget available. And it might be 6, 12 months, 18 months down the track before tax authorities do start to follow up. So what should companies be doing in the meantime to start building their file, and what sorts of things should they be thinking about? You want to take that one on, Sharon?
Sure. Look, I think what's going to be important now is documenting A, what your decision is, and then B, why you've taken that decision. So my webcam appears to have frozen, so apologies. This probably isn't what I'm looking like. But I think those are the two things that you must document, because in the absence of any comparable data or other robust information, why you've done something is incredibly compelling. Even in hindsight, it is incredibly compelling, because when you come 6, 12, 18 months down the line and the tax office comes in and says, why did you, and says, well, you know, you shouldn't have done this. If you have documentation that explains why you've done something, it's going to be easier for that hindsight to make sense. So it's not just about what the inputs were, but what was the thinking, what was around the decision making, what were the factors that were present at that time that led you to make that specific decision at that time. Now, I'm not suggesting you write a big paper. I'm not suggesting that you go out and you know, put together wraps for every single TP position you've taken, but even if it's just dot point, this is the decision taken, this is the pricing, this is why, and this is the information we relied upon to make that decision. That way, even if you have to change your decision later on for whatever reason, you'll know the context in which it was made and you'll know what levers you can pull. So I think the dot point, the more information you have, the better, but I think more so than ever, why you've made the decision is important. And that typically, I would say, is not necessarily normally documented. We normally document the what, and we document the industry analysis and the economic analysis, but rarely would you document why you've done something that way. And I think in the absence of other information, other verifiable, comparable information, why you've done something is important. And obviously, don't say I've done it because there was a tax benefit. I think that don't say.
I might build on that as well, just in terms of the documentation, the timing of that documentation and the importance of it. I know we have IFRIC 23 in the title of the presentation today, because that's the other main issue where you do need that documentation, and the timing of it might be different. So traditionally, you might do your documentation to have a wrap. In other words, it's contemporaneous with the lodgement of your tax return. But for IFRIC 23, you need to have sufficient appropriate audit evidence available when the auditors are actually ticking off the particular positions that have been adopted in your books and records. So I would even go one step further to say, yes, it's important to get those key bullets down, but I'd actually make that presentationally ready for being available to the auditors and the specialists who might be helping the auditors to be able to support the views that have been adopted when in respect to those positions.
Mike, I have to say, if you can throw around terminology like sufficiently appropriate audit evidence, you've spent too much time with auditors.
I think it's absolutely right. I probably have, but I practically, I've worked on a lot of year-end audits where there are undocumented transfer pricing related positions. And those are the really challenging ones, right? Because when it comes to IFRIC 23, you have to assume that the tax authority will find the issue and it'll be assessed based on its technical merits. And, you know, you assume it gets all the way to the end of that process. And where a taxpayer client sort of has a view, has a position, and it might be quite reasonable, but it's not documented, it becomes very difficult to say to the audit team, yes, I can give you a sign off on this, because otherwise it kind of feels like without that documentation, you're almost relying on Flip of the Dolphin to sail in at the last minute and save you. Whereas if you document those positions, then you can understand why the position's been taken and why.
Yeah, and Mike, you know, IFRIC 23, being the first time it's being implemented, is now also saying that the auditors will have their own transfer pricing experts looking, or tax experts potentially looking at these uncertain tax positions, and also casting an eye over that and say, you know, you've said this is your position, it's an uncertain position, this is your justification, but what do our auditor experts think of that? And that will result in accounting treatment and potentially booking a provision. So, you know, absolutely important to make sure that we have the documentation, what are our uncertain positions. And I don't know whether in the past we went that far. So listen, these ones very confident, these ones uncertain, you know, and how uncertain, and now how are we going to treat that? And are we booking provisions? So it's a new world, a brave world.
Yeah,
if I can just sorry, Zara, I was just going to say, if I can just add to that from a purely practical perspective, one thing I learned and did a lot of in my professional services days were file notes, and they're not as pretty as position papers, but they're highly effective. They're in times like these when you have no time and you have to document as much as you can. That good old file note is a practical lifesaver. So highly recommended.
Yeah, and Sharon, what I'm often finding with clients is, you know, or even our staff, they would say, Aletta, the client's not given me something in writing, and I'm not getting it from the client. And I'm saying, but your client is busy. Our client is busy. What about picking up the phone and making notes as you speak to the client and shoot them an email and say, just to confirm, this is what we've discussed, and then you go on. You know, the client is busy. Let's find another way to deal with that.
Yeah, I agree with that. I think we've just been through a 31 December sort of IFRIC 23 review, or well, we're still going through it, to be honest. And there's been a lot of interesting discussions and debates through this process. And I think there's a very strong learning curve amongst the sort of auditor community as well, because as you say, Aletta, we haven't had this sort of focus on uncertain tax positions before, and transfer pricing is by its very nature uncertain. And now at 30 June 2020, I think that's even harder for auditors and for companies, because we have uncertain tax positions in a very uncertain environment with COVID-19. So we've got this sort of double whammy. So I think the level of analysis, the level of documentation, I mean, there are some companies that have never even done transfer pricing documentation. So to Mike's point, you know, they're very behind the 8 ball, and they will find most likely, if transfer pricing is potentially material, that their auditors are going to give them, you know, quite a hard time. So I think it's an interesting driver, not just for tax purposes, but for accounting purposes, that the quality and quantity of transfer pricing analysis is going to be key. And maybe we'll see reviews by, you know, ASIC and the like as well in time to come, to see, you know, how well those new accounting regulations have been followed, or accounting standards have been followed. I'm just going to, we've answered a couple of the questions that have been going through, which often is the case because one point leads to another and, you know, someone's thinking about the same thing. So that's good. I'm just going to ask, just for some practical recommendations, perhaps there's some final comments from each of you. So what would you say is your, you know, number one or two practical recommendations that companies should be doing as they approach year end, whether it's 30 June or September or whenever it might be? Mike, could I start with you, please?
Sure, yeah, absolutely. So I think a year-end planning meeting is key. So I know clients that do this, and I know some that don't. And if you have the year-end planning meeting where you sit down and you talk not just about transfer pricing, but tax and accounting issues as well, you can be forewarned and forearmed as to what those challenges are going to look like as they come in. So it's really, my practical suggestion is have a formal meeting to table these issues and do it in timely fashion.
Thanks, Mike. Aletta, any practical accounting observations?
Zara, I think it's really important that entities are finding a mechanism to stay up to date with the latest developments. As I said, as recently as a week ago, the International Accounting Standards Board made a change to a brand new standard that we're applying for the first time. And there are some amazing commercial benefits in that change if you understand the change. You know, so if you were aware of the change, you understood the commercial benefits and you could act accordingly, you know, it would be really beneficial. So I'm suggesting that people tap into in their organization who are the experts. Let's speak to each other. I love the idea to speak to transfer pricing people, to speak to tax people and say, what are your pressure points? Because look at this today, we have similar issues, similar concerns, and the only way we can practically resolve it is latest information and a brainstorm brains trust.
Thank you. Sharon, the last word on practical tips before I close. You must have some years of experience that you think about, you know, you put into practice before year end. I know this year end's a particularly more challenging one, but what are some of your thoughts and tips?
Well, one thing I do regularly, so not necessarily just at year end, but regularly is to plot a TP map. So that's got all of your related parties, all of your transactions, whether they're pre or post year end. So I map that out. And one thing I think this year we've got to do that is possibly different to the years gone by is to look at each. So you have this map in front of you. You've got to look at it and ask yourself, play devil's advocate essentially, and say, well, what could possibly change? Because the reality is when we come out the other side of this pandemic, all, as you said earlier, all of the stimulus packages will need to be repaid. This is not a free kick. We are going to have to pay this back. And chances are we're going to have to pay this back by way of tax because there's no way else to get the money back. So you're virtually guaranteed that at some point in time, in some way, shape or form, there will be tax reform coming in each of the countries that you're in. Now, it might take a year, it might take 3 years, it might be immediate. Some countries are already talking about it, but the reality is tax will change. I think this year more than ever, it's important to try and predict how that might change based on information that is currently available, so stuff that's already been announced, how the governments have behaved before, and what you would do if you were a tax authority, and then apply that to your transfer pricing map and ask yourself, do I want this map to be here when that change comes through 6 months, 12 months, 18 months down the line? If you're happy for something that's not currently taxable to be taxable or to be treated differently, then that's fine. Your map is fine. If you think that, no, this is not something that I want in place long term, then I would say start your documentation now, speak to your advisors if you have TP advisors, and work out a plan that gives you essentially your cake and what's the saying? Have your cake and eat it too. That'll give you the ability to put in place the transfer pricing measures you need to put in place to get you through the pandemic. Because at the end of the day, what governments want is companies to come up the other side, because then they can be good little taxpayers. So take advantage of what is available to you. Work within the transfer pricing rules of the countries that you're in, but make sure that you've got a story that you can change as the economic conditions change. So I think that's the one thing I would do differently this year end. I think we don't necessarily do that quite robustly because things don't change year on year. But this year things have, and I think it's a great opportunity, and it'd be a shame to waste it.
Yeah, I think that it's nice to leave with the silver lining. I always like to look at, my glass being half full rather than half empty. And I think that's the message, Sharon, that, I think that corporates, governments, individuals are all going through a terribly difficult time during COVID-19. But let's look for that silver lining. Let's look for how we can learn from this and how we can benefit from this. I think that, for all of us in the discussions that we're having with colleagues, clients, etc., everybody's looking for the upsides. Rather than just sort of focusing on the downsides. And, unfortunately, we've just lost Sharon, but we'll close the discussion anyway, the webinar anyway. So
I'm here.
look,
just no video, but I'm here.
Ah, okay, great, thank you.
Yeah.
I can just see a black box. So there you go. And look, one
Technology,
topic,
gotta love it.
technology, that's right. One topic we didn't talk about today in terms of technology or online is digital, but we'll pick that up on one of our future webinars because there is certainly a lot happening in that space, and a lot yet to come from the OECD as well. So look, one out goes really quickly. I'd like to say thank you to all of the panelists for sharing your practical insights and your thoughts today. The focus, of course, was on year-end planning, and hopefully we've touched on lots of those, given you lots of food for thought for your own year ends. Just a reminder, the next webinars, there's one next Wednesday which will deal with short-term and long-term issues for consideration. So we will build on some of the topics that we've raised today. Then one after that on the 24th is legal agreements, as I said, and then finally finishing with one on financing with the tax office as well. So thank you for your participation today. You'll receive some key messages and the recording of the webinar to watch at your leisure or share with colleagues. But thank you for your participation. Thank you very much to all of the panelists today. And I wish you good day, good morning, good evening. Enjoy the rest of your day. So thank you very much, everybody. Bye-bye.
Bye-bye.
Goodbye. Thanks, Zara.
Everyone.